comment was made earlier about what I was talking about in the beginning of the pandemic when the market got absolutely smashed and recovered. It's important to understand, and I probably on purpose didn't point it out at the time, that the pandemic occasioned a quite spectacular very short-term financial crisis. But if you go back and look at my favourite spread, which talks about, which describes liquidity in the US wholesale market, that is to say the difference between investment grade debt and sovereign debt in the US, the BAA spread, which you can find in the Federal Reserve database, BAA spread Fred is what you type in to look at this. What you'll see is a very spectacular spike in that spread in the beginning of 2020. So there was a really major financial crisis going on in the first, really in the second quarter of the pandemic. And that's why, that's where all of this cheap money came from, because the Federal Reserve, the Bank of England, our bank and other banks, all together acted to ease monetary policy to solve that crisis. So there was a very significant crisis. And that crisis and that spike in rates had a remarkable effect on the pricing of equities. And what we see in the data since 2019 is there is a spectacular rise in the importance of liquidity in explaining what stock markets do, or doing at the moment anyway. So what's happened is, what you'll see in the next quarterly is I've changed the time period over which I'm calculating fair value of the model to just the most recent period since 2019 because of these really big swings in liquidity that we've seen. And from a liquidity crisis back in 2020, what we've got now is a liquidity bubble, the opposite. The biggest liquidity bubble in the period that Milton Friedman was looking at when he wrote this up, hadn't actually yet happened, was about to happen. The biggest liquidity bubble in this measure is in the 1960s. In the 1960s, there was a lot of government spending and unemployment was very low, just what we've got now, okay? And corporate profits were good, just like we've got now in the US economy. Pretty much the same kind of things. And so what we've got is we've got extremely low measures of this corporate liquidity measure, which means we've got an awful lot of corporate liquidity. And that's what's holding the market up or driving the market up. And I did the first tape I did about this is the one I did at the very end of last year. 2024 will be a better year. And I show this measure and I talk about Milton Friedman identifying this as a driver. So these models throw greater emphasis on corporate liquidity in addition to the traditional drivers of the equities market, which are earnings per share and bond yield. But what we're living through now is a corporate bubble, which is driven by low unemployment and big budget spending, exactly like the 1960s. Okay, so the 1960s is the comparative period. So now some of these models aren't statistically quite as good as in the previous period, but they function pretty well for what we're looking at. The S&P 500 model, what this does is it now explains 76% of monthly variation since the beginning of the period. And like I say, both in at the top of this and in 2022 and now, you've got very low corporate spreads. So fair value in this, as of yesterday, for the S&P 500 was 4,431 points. The actual level was 420 points higher than that. So that is, of course, a standard error too high. Normal behaviour of the S&P 500 is to peak in the middle of February, which is next week, and then come down to a low in March, and then kick up again later in the year. The low is usually in September. But right now, we're just in the position, we're not as overvalued as we were, say, in previous periods, but we are a standard overvalue, and I think it's reasonable to expect that the S&P 500 will have a seasonal correction between now and March. The All Ordinaries, the model is actually better for this than for the XJO. The model for the XJO is actually better than the model for the S&P 500 and explains 84.2% of monthly variation. There's a big influence on corporate spreads on our value, really because of the interaction between us, because we pay much higher dividends than the US market does. And so it's interacting, these corporate spreads are interacting with our market as if we are a type of a fixed interest security. So when there's plenty of liquidity, our market is much, much higher because of the high franking credits that we pay and high dividends that we pay. So it has a dramatic influence on us. So even though, as I pointed out last year, there was a decline in earnings, and there still is a decline in earnings over the situation a year ago, this enormous amount of corporate liquidity is supporting our stock market. So our fair value is 7,400 points exactly in terms of this model, and we are currently about 180 points too high, which is less than the standard error too high. So right now we are slightly less overvalued than we are moderately overvalued, but not overvalued at a statistically significant level. So here we are. We're being supported by economic conditions that haven't been seen since the 1960s, of low unemployment, big government spendings, and low corporate spreads. I'm amazed because I never thought I'd see the 60s again.